In 1875, an Ohio farmer named Samuel Benner published a hand-drawn chart of American booms and panics. And on that chart, the year 2026 sits in the row he labeled Years of Good Times, High Prices, and the Time to Sell. He drew it 151 years ago. This week, it's going viral again. And the farmer is the least interesting part of the story. Because this same week, the 30-year Treasury yield closed at 5.2%, the highest in 19 years, while the stock market sat at record territory. Money walking away from the longest promise the government makes and crowding into stocks. Those two things are not supposed to happen together. So I did something the headlines won't do. I pulled the public filings of the people running this system, the annual financial disclosures, the SEC filings, the Federal Reserve's own ethics paperwork. And sitting in those documents, in black and white, is the real story. The people in charge of this melt-up are quietly positioned for what comes after it. Stay with me because I'm going to put a map on the table. The 4 stages a billionaire investor spent 5 decades documenting. The pattern every dying reserve currency has walked. And then I'm going to read their filings against it, what they're buying, what they're losing money on and buying anyway, and the one asset in their paperwork that has no printer attached. I'm Tim, 17 years inside the lending machine, and now I read the filings so you don't have to. Every number you're about to see is live on the same screen I'll be watching as this plays out. More on that in a bit. Let's start with the question everyone is asking, because it's the wrong question. How much longer can this market go up? People have been asking that for 2 years, and the market has embarrassed every one of them. It already defied reality. It ignored the highest rates in a generation. It ignored a war. It ignored 5 straight years of inflation above the Fed's own target. Asking how much longer assumes the market is behaving irrationally and will eventually sober up. Here's the part almost nobody says out loud. The market is not behaving irrationally. It's behaving exactly the way markets behave in the late stage of the pattern. When smart money starts treating stocks not as a bet on growth, but as a lifeboat out of the currency. Think of it like a flood tide. The boats aren't rising because the boats got better. The water is rising underneath them, and the water is money. When people say crash up, that's what they mean. Prices melting upward while the thing you measure them in quietly loses its footing. Now here's the tell, the one buried underneath the headlines. Back in 2009, of everything foreigners owned in America, 23% was stock. Today, it's 56%. More than half of what the world holds here is now equity, not treasury bonds, not the government's promises, stocks. And this very week, the market backed away from the 30-year bond hard enough to push its yield to a 19-year high, on a day the Fed did nothing at all. Let me put Wednesday afternoon in dollars, because this already happened. It's not a forecast. A 30-year Treasury lost about 1.66% of its value in that single session. That's $1,662 per 100,000 in an afternoon. That's our arithmetic on a standard bond, and I ran it twice before I said it out loud. Bank of America's economists looked at that same session and wrote a sentence you don't see from a major bank very often. They said the market's moves were, quote, consistent with a central bank inflation credibility shock. A strategist at Brandywine put it even more plainly, quote, the long end doesn't buy into his inflation fighting story. Here's the strangest part of Wednesday, and it's the detail that unlocks everything else. While the 30-year was selling off, the 2-year Treasury actually went up in price. Same afternoon, opposite directions. Why does that matter? Picture your neighbor asking to borrow $100 until Friday. You'd probably do it. A week is easy to trust. Now picture the same neighbor asking to borrow it for 30 years. Different conversation, isn't it? Nothing about your neighbor changed between those two sentences. What changed is how far into the future you have to trust him. That's the entire bond market in one story. On Wednesday, the market said, "We'll trust Washington for 2 years just fine." 30 years? That costs more now. The short end prices the interest rate. The long end prices the promise. And the promise just got marked down to a 19-year low of trust on a day when nothing else happened. The world is walking away from the long promise and piling into the stock market. That is not confidence. That is repositioning. And it's the first check mark on the map. Now I need to walk somewhere that sounds political. It is not. There will be no parties in this video, no candidates, no names, because the pattern I'm about to show you has played out under kings, republics, empires, and every flag you can think of. This is about a system, not a team. Ray Dalio built the biggest hedge fund on earth, and he spent decades studying one question: how do the world's dominant currencies die? He went back 500 years, the Dutch guilder, the British pound, everything before and between, and he found the same sequence every time. Stage 1. The debt builds past what can honestly be repaid. We're there. The national debt is closing in on $39 trillion, and the interest bill alone now competes with the entire defense budget. Understand what that means mechanically. The government now borrows money to pay the interest on money it already borrowed. Any family that's ever ridden a credit card knows exactly what stage that is. It's the stage where the balance stops being a number you manage and becomes a number that manages you. Stage 2. Conflict inside the country rises, and trust in the institutions falls. I'll let you judge that one from your own front porch. Stage 3. Conflict outside. Trade wars, capital wars, shooting wars. In January at Davos, Dalio said this about the global money system, and I'm quoting him word for word. Let's not be naive and say, "Oh, we're breaking the rule-based system. It's gone." 2 weeks later in Dubai, he warned, quote, "We are on the brink of a capital war." His words, on stage, this year. And you don't have to take his word for the shooting part. The Federal Reserve's own July statement blamed, quote, "supply shocks," and named the conflict in the Middle East as a source of elevated uncertainty. The war stage isn't a prediction anymore. It's in the Fed's own press release. And then, stage 4, the last one. The government arrives at a fork with only two roads: default on the debt honestly, or print the money and pay it back in shrunken dollars. Dalio's finding, across 5 centuries of these cycles, is that when governments face that choice, they have always chosen to print. Always. And you don't need a history book to believe that. Most of you watching lived through the American version of it. August 1971. The government's gold obligations had grown past what it could honor, so one Sunday night on television, the gold window was closed, quote, temporarily. That word did a lot of work. The temporary suspension is now 55 years old. And what did the exit asset do once the printing was unchained? Gold went from $35 an ounce to over $800 by 1980. The people who watched the behavior instead of the speeches, who noticed what the money nearest the problem was doing, had 9 years of open door to walk through. The ones who trusted the word temporary paid for the decade. That was stage 4, the last time it ran. You were there, which is exactly why you're the person this pattern can't fool twice. Here's the kitchen table version. Picture a man drowning in debts he can't pay, but he's got a machine in the basement that prints legal money. Is there any version of that man who chooses bankruptcy? Of course not. Not because he's evil, because the machine is legal and the bankruptcy isn't survivable. Now understand, the country you live in is that man, and the machine is real. So that's the map: debt, division, conflict, print. 4 stages, 500 years, no exceptions on the last step. The honest question is, where are we on it, really? Speeches won't tell you. Officials will never announce the fourth stage. Announcing it causes it. So you check the same way you check anything in this economy. You ignore what the people nearest the printer say, and you watch what they do with their own money. When a currency starts dying, the people standing closest to it move first. They always have. So let's read their filings. Everything I'm about to show you is public record. No leaks, no rumors, just paperwork anyone can pull. Filing number 1. The most powerful office in the country. The annual financial disclosure released at the end of June shows more than $1 billion of income from crypto ventures in a single year. NBC added it up to roughly 1.4 billion. Read that again. Not stock dividends, not bond interest, not real estate. Crypto. I'm not naming names, and I'm not making a political point. The document makes the point. The very top of this system is now being paid through rails that run outside the dollar. Filing number 2. The Chairman of the Federal Reserve. And I want to be precise here, because precision is the whole product on this channel. His ethics disclosure does not show him holding Bitcoin directly. Anyone who tells you otherwise hasn't read the filing. What it shows is arguably more interesting. A portfolio holding stakes in more than 30 blockchain companies. A direct position in the Lightning Network, that's the payment system built on top of Bitcoin. A fund position north of $100 million. And before this filing, an investment in the firm behind one of the spot Bitcoin ETFs. The man whose signature controls the dollar walked into the Federal Reserve holding a portfolio full of the exits. Filing number 3 is my favorite, because it's the one where they're losing. There is a Bitcoin mining company, publicly traded, co-founded by the family of that most powerful office. It has now posted 2 straight quarterly losses. The family fortune is down roughly $600 million on the bet. $600 million, gone, on paper. And what did they do in March, in the middle of that bleeding? They bought 11,298 more mining machines, grew the fleet 12%, at the exact moment rival miners are giving up and pivoting their warehouses to AI. Stop and feel the weight of that. You do not eat $600 million of losses and buy more machines because you like this quarter's returns. The returns right now are terrible. You do it because you believe the machines will be worth more than the dollars they're burning. That is what patient hands look like when the trade is early. And patient hands with that kind of information advantage don't guess. So the map says late stage, and the filings say the people in charge are positioned. The obvious question is the one I can't answer with a date, and neither can anyone else who's being honest with you. There are no certainties here, only probabilities. What I can give you is the sequence the data supports, and then, at the end, the 3 signals that will tell you in real time whether it's on track or broken. Here's the sequence. September, the Fed hikes. That's not my invention. Bank of America is on record expecting a quarter-point hike at every remaining meeting this year, because in their words, the Fed has to eventually, quote, walk the talk or risk losing credibility. 5 years above target, a bond market already charging them for it. The pressure only points one way. October, or whenever the hike bites, liquidity tightens. And here's the part that shakes people out. When liquidity drains, everything falls together at first. Stocks, gold miners, and yes, Bitcoin falls too. It happened in March 2020, when Bitcoin touched $3,800 in the panic before the printing started. If the recession the old farmer's chart points to shows up on schedule, expect that ugly moment again. The people who don't understand what they own will sell it there. The filings you just heard about tell you who will be buying it from them. Then watch gold. Gold moves first in this stage. It always has. Because it's the exit the old money already trusts. Dalio again, this year, word for word. Gold is the second largest reserve currency, and, quote, when the bad times come along, it does uniquely well. The world's central banks are living proof. They bought roughly 1,200 tons of it last year, while the dollar's share of global reserves slid under 57%, the lowest since 1995. The exit from the dollar isn't a theory, it's a bar chart, and it's already 3 years long. And then comes the flip, the moment this channel exists for. At some point in that sequence, Bitcoin stops trading like a tech stock and starts trading like gold's younger sibling. It's done this before at smaller scale. Fall in the panic, then run ahead of everything once the printer turns on. Because here's the question every saver on Earth ends up asking in stage 4. They're printing again. Where do I stand that they can't print? Gold is the 1,000-year answer. Bitcoin is the same answer with one improvement. Nobody can even dig up more of it, and the flip has a mechanism now that it never had before. This is the part that's different from every previous cycle. The rails are built. Since 2024, there have been spot Bitcoin ETFs sitting in the same brokerage window as the gold funds, one ticker apart. When the gold trade gets crowded, and in stage 4 it always gets crowded, the same allocators who chased it start reaching for the next hard asset on the shelf. With gold, high prices summon new supply. The miners dig harder, and every gold rush in history has eventually watered itself down. Bitcoin's schedule doesn't answer to price. The supply arrives on the same timetable at $400 or $400,000. The chairman of the Federal Reserve holds the payment rails for it in his own disclosure. The demand door has been institutionalized, and the supply door was welded shut in 2009. That's the flip. The moment the crowd exiting the dollar discovers the second exit has no ability to dilute them. Every price in that sequence, the 30-year yield, gold, Bitcoin, is live on my macro command center right now. The same screen I've been reading these numbers from this whole video. Now, the question a smart skeptic should be asking, why can't they just run the 2008 playbook again? Crash, print, cover it, move on. It worked before. Because in 2008, the printer still had its credibility. Inflation had been asleep for 2 decades, so when they printed trillions, the bond market shrugged and let them. That trick has now been used. 5+ years of inflation above target later, the market has stopped forgiving the printer. That's what a 30-year yield at a 19-year high on a do-nothing Fed day means. That's what inflation credibility shock means when Bank of America writes it. The market is telling you in basis points, we will still lend you money for 2 years, but 30? 30 years is a promise we no longer fully believe. So walk the logic to the end and don't flinch. The crisis comes, this year if the cycle is right, later if it's not. The government faces the fork, default or print. 500 years say print. But this time the printing doesn't get forgiven, it gets priced, instantly, into everything. Into groceries, into the long bond, into the dollar's reserve share, which is already sliding. The cover-up tool of 2008 becomes the accelerant of this one. And that's the moment the melt-up is revealed for what it always was, the final costume the theft wears. Your neighbor's brokerage account looks magnificent, measured in a unit that's failing. The boats are high because the flood is high. A man with his life savings in that water needs to know which of his assets are boats and which are anchors. And he needs to know it before the tide turns, not after. So look at the exits they're selling you, one at a time, and ask a single question about each. Who can make more of it, and who can take it? Your stocks, record highs, in a currency being repriced, and they're already tokenizing the plumbing underneath them. Your bonds. You watched a 30-year lose $1,600 per 100 grand in an afternoon. Your house. Sits in a registry they control and are working to tokenize. Even the crypto dollar, the stablecoin, showed its true nature this month. One company, on one government order, froze $131 million belonging to a foreign central bank. In an afternoon. No court fight. If they can freeze a central bank, the question of whether they can freeze you isn't a question. Every exit on that list has an issuer, an owner, or a switch. Every single one except one. Bitcoin. 21 million coins. Fixed. Forever. There is no chairman of Bitcoin who arrives with a portfolio and a plan. There is no board meeting that can vote the supply higher. There is no family that gets paid first, no ethics disclosure to read, because there is nobody to disclose. No servers to raid, Only a protocol, running the same rule tonight that it ran in 2009. And here's what the filings told you tonight without meaning to. The people in charge can't print themselves any of it. When the most powerful people in this system want Bitcoin exposure, they have to do exactly what you would do: buy it, or spend $600 million mining it at a loss. That may be the most honest thing about this entire story. At the door of this one asset, the man who runs the printer stands in the same line you do. I'm not telling you to buy anything. That's not what this channel does. The moment I start yelling back up the truck, I'm just another salesman, and you've had enough of those. What I'm handing you is the pattern, the filings, and the probabilities. When trust in a currency dies, it dies slowly and then suddenly. And the people who did fine were never the loudest ones. They were the patient hands who positioned before the flip, and then did the hardest thing in finance: nothing. Lower risk, longer time, stronger hands. The filings say that's exactly how the people in charge are playing it, losing money this quarter, positioned for the decade. So let's close the loop I opened at the top. Why is a hand-drawn chart from 1875 going viral in 2026? Let me be straight about that chart, because credibility is the product here. A farmer's drawing is not a forecast. Its hits get cherry-picked, and its misses get forgotten. And if the whole story were Samuel Benner, I wouldn't have wasted your evening on it. The story is that in the exact year his chart marks sell, the people who run the money are acting like sellers. The disclosure says a billion plus in crypto income at the top. The Fed chairman's paperwork is full of blockchain rails. The family mining operation eats 9 figures of losses and buys more machines. The old chart doesn't matter because it predicts. It matters because this year the behavior of the insiders finally rhymes with it. Two scenarios from here. No false certainty, you know how this channel works. Scenario 1. The cycle is roughly right. The Fed hikes in September, something cracks into the fall, liquidity drains, everything drops together, Bitcoin included, and then the fork. They print. Gold leads, Bitcoin follows, and then outruns it. And the people exiting the dollar stop being early and start being ordinary. Scenario 2. The melt-up runs longer than anyone believes. Melt-ups always can. Stocks grind higher in nominal terms, the crash-up continues, and the theft just compounds more quietly, while the same filings keep filling with the same assets. In that world, you lose nothing by understanding the pattern early. You simply get more time at the door, at better prices, standing next to some very patient, very informed hands. Either way, both roads end at the same fork, and 500 years of history says which way they'll turn. 3 signals to watch: specific, dated, checkable. Signal 1, the September Fed meeting. Does the hike come? And how many dissenters? The pressure that forced 3 dissents in July only builds. Signal 2, the 30-year yield and gold, together. If the long bond stays above 5% while gold rises on the days stocks fall, the repositioning is accelerating. Signal 3, the next quarterly filings from that family mining company. If they're still buying machines through the losses, the most informed patient hands in the country are still telling you, in paperwork, under penalty of law, what they think comes next. A farmer called the top 151 years ago. Maybe he's wrong. He's been wrong before. But the people in charge are acting like he's right. And their filings, not their speeches, are the testimony that counts. If you want to watch those 3 signals with me, instead of hunting them across 10 websites, it's free, no credit card, 2 minutes. Take the money quiz at timtalksfinance.com/members. You'll see the same live numbers I used tonight. What inflation is actually costing your cash in dollars per year? And one move worth considering for your situation. I built it so you don't have to figure this out alone. I'm Tim. This is Tim Talks Finance. And wherever the truth lands, you've seen where it keeps landing. I'll see you in the next one.